Hi, so today we are going to start with a new chapter, that is capital gain. Now, as you might aware, in the first slide we have discussed about different heads under which income can be charged to tax. So that were business and profession, salary, income from house property, income from other source, and apart from that there was one more head, that was capital gain. And that is the head we are going to start from today. So, when I say capital, let's discuss about the definition and how the capital gain can be charged. So first, what is capital gain? So, any profit or gain arising from the transfer of a capital asset made in the previous year are taxable under the head of capital gain, which means if you are selling any capital property in the previous year or capital asset in the previous year, and whatever gain you are earning by selling that property will be charged under the head of capital gain. So now the question might come, sir, what do you mean by capital asset? So let's discuss what is the meaning of capital asset. So when I say capital assets means property of any kind, whether it is fixed, circulating, movable, immovable, tangible or intangible. Every kind of properties are covered under the head of capital asset, whether or not they are connected with the business or profession. So in a nutshell, I can say any capital asset which are sold in the previous year, and by selling that asset, if you are gaining any profit, by profit which means the difference between selling price and purchase price, if you are gaining any profit, that will be charged under the head of capital gain. Now there are certain exemptions which are given under the head or under the name of capital asset. So I am going to show you certain assets which are covered under the definition of asset, but they are not capital asset. The first is stock in trade. Any stock which you are holding in your business, and if you are going to sell that stock, that will not be part of capital gain because it is already been charged under the head of business and profession. Any other asset which are of personal effect, which means any personal asset which you are using, so which can cover your motor car, which can cover your clothes, etc. But again, now in that case, government has specifically said that although personal effects asset will not be part of your capital asset, but in that exception there are certain other exceptions. So if I am selling jewelry or costly stone or silver or gold or any costly painting or sculptures, etc., they are the exception of the exception, which means they will be part of your capital asset. The third one is any agricultural land in rural area. And the fourth one is there are certain bonds which are prescribed by the government, so those bonds will not be part of capital assets as well. So all the exceptions which are given, even though you are selling that asset in the previous year, that will not be part of your capital asset, and hence no capital gain would be charged on the same. Coming to the next slide, let's talk about type of capital gain. So there are two kinds of capital gains. One can be short-term capital gain, one can be long-term capital gain. Let's discuss what are the assets which are covered and what are the time period under which an asset can be considered as a short-term or an asset can be considered as a long-term. First, let's talk about three assets. One, listed equity shares. Second, units of any equity-oriented fund. Or third, zero coupon bonds. Mark this. Here I have used the word listed equity shares. So all these three type of asset, if these assets are sold within the time period of 12 months or less, which means if I am purchasing listed equity shares today and I am going to sell those listed equity shares within the time period of 12 months, whatever capital gain would be charged on the same would be short-term capital gain. However, if I am holding those shares for more than 12 months period and after 12 months I am going to sell those shares, that will be considered as a long term. With respect to other assets like land, building or unlisted shares, for that the time period which is given for short term is 24 months and for long term it is 24 months after 24 months, which means again I am purchasing a land today and if I am going to sell that land after the time period of 24 months, long term capital gain would be charged, but if I am going to sell that land before 24 months, short term capital gain will charge. And all other assets which will include units of debt oriented fund, because unit of equity oriented fund has been covered under 12 months. So units of debt oriented fund, unlisted securities, mark this is not unlisted shares, this is unlisted securities. So unlisted securities other than shares or all other capital assets, for that the time period is 36 months, which means before 36 months if you are going to sell, that would be short term capital gain. After 36 months if you are going to sell, there will be long term capital gain. Now the question which might come, sir, we understood what is the difference between short term and long term capital gain, but what is the difference when I'm going to calculate short term capital gain and long term capital gain? So coming to the calculation, when I'm calculating short term capital gain, this is how the calculation will be done. Whatever your sales consideration, you need to put that sales consideration. From that, the purchase price of that asset will be reduced, and whatever difference will be that would be considered as a capital gain. For instance, if I am selling a land which I have purchased before 1 year for the amount of 1 lakh rupees, and I am selling the same land for the price of 3 lakh rupees. So sales consideration is 3 lakh, you have reduced your purchase price 1 lakh, and the difference of 2 lakh rupees would be considered as your short term capital gain. So how to calculate long term capital gain? So method is more or less same, but there is one more point which will be added, that is indexation. So again, you have to put first sales consideration. From that, you will reduce your purchase price, but that purchase price will be adjusted with the indexation. So what is indexation? Indexation is a system or technique used by an organization or government to connect the price of the assets with the value. Sounds a bit technical, right? Let's understand it by an example. Let's say I have purchased a property in financial year 2001-2 which had the price of 20 lakh rupees, and I'm going to sell the same property in the financial year 1920, but due to inflation the price in 1920 is 2 crore rupees. Now when I'm going to calculate the capital gain, what I need to do is to reduce my purchase consideration from sales consideration. Here my sales consideration is 2 crore and my purchase price is 20 lakh. And in that case, I'm going to suffer with the huge amount of capital gain, and that would be around 1 crore 80 lakh rupees. Now the contention would be, sir, the price of 2001-2 and the price of 2019-20 cannot be comparable at all. And that is completely right. And hence, government is giving indexation number every year. So while you are calculating indexation, what you need to do? You need to connect the value of your asset with the price of indexation number. Sorry, with the amount of indexation number. Let's understand it by an example. So let's say your value of property in 2001-2 was 20 lakh, and at that point of time indexation number given by the government was 100. The same property you are selling in 1920, and you are selling that property with the price of 2 crore rupees, and the indexation number given by the government is 289. Now sir, what you need to do? You need to connect the price of 2001-2 with 2019-20, which means you have to do the simple cross calculation. That sir, in 2001-2, if indexation number was 100, at that point of time the price of my property was 20 lakh. So in 1920, when the indexation number is 289, what would be the price of my property? So that would be simply 289 into 20 lakh divided by 100. And now your purchase price after applying the indexation is going to be 1 crore 17 lakh 80,000 rupees. And now when you are going to calculate the capital gain, that would be sales consideration of 2 crore minus purchase price of 1 crore 17 lakh 80,000. And hence your capital gain would comparatively very low. So I guess you understood the concept of indexation. In the next session, we are going to discuss about exemptions under section 54 which are given under capital gain. Thank you.